Why Nitin Nabin's BJP restructure could unlock India's $500 billion defense tech export corridor. The market is still pricing the wrong constraint. Capacity on paper and capacity that ships are not the same problem. We trace cause, incentive, and downstream impact in order. But organizational restructures at the national level are never routine. They're rehearsals for policy, signals about which sectors will get accelerated budgets, regulatory fast tracks, and cross-ministry coordination. This one matters because India is about to capture a piece of aerospace manufacturing that could reshape its entire export economy. Here's why. For decades, India's aerospace manufacturing has been fragmented. Yes, Bangalore and Pune produce components for Boeing and Airbus. Yes, HAL and a few hundred private firms compete for scraps. But India's total aerospace supply chain work hovers around $8 billion annually. Poland captures $20 billion. Malaysia captures $15 billion. Vietnam is closing in on $12 billion. India, despite having 1.4 billion people and a world-class IT services backbone, has stagnated. The reason isn't talent or cost. It's institutional friction. Export controls take 18 to 36 months. Regulatory sign-offs require approvals from DRDO, the Defense Ministry, and sometimes the PMO's National Security Office. By the time you get clearance to bid on a US contract, the contract is already filled. That's the problem Nitin Nabin's restructure is designed to solve. Let's be clear about what Trump's 1,000 launch directive actually means. SpaceX is already flying 60 times a year. With Starship, they're targeting 100 plus. Blue Origin, Axiom, Relativity Space, and a dozen other US companies want to launch monthly. The US government is mandating 1,000 launches annually across military, commercial, and civil sectors combined. That's roughly 20 launches every single week, forever. No supply chain on Earth can handle that without fragmenting production globally. The US cannot build all the avionics harnesses, composite fuselage sections, landing gear subassemblies, and ground support equipment domestically. They'll have to source internationally. And here's where India's moment arrives. The US is actively reshoring aerospace supply chains away from China. India, as a Quad member with demonstrated tech capacity and stable geopolitical alignment, is the natural alternative. But India can't capture that work unless it removes three institutional bottlenecks. First, regulatory fragmentation. A streamlined export pathway could reduce approval timelines from 24 to 36 months to 90 to 180 days. Second, export control rationalization. Current rules treat aerospace components as sensitive, requiring ministry-by-ministry clearance even for US transfers. A rationalized policy framework, think CAATSA adjacent or trusted partner designation, could unlock $30 to $50 billion in latent annual potential within 18 months. Third, workforce scaling. India produces 200,000 engineers annually, but only 8,000 to 10,000 are trained in aerospace systems. A coordinated national initiative could scale that to 40,000 to 50,000 within 3 to 4 years, sufficient to absorb half of US demand growth. Now here's where it gets interesting for India's broader economy. India's $230 billion IT services industry, TCS, Infosys, Wipro, HCL Tech, has historically treated aerospace software as a niche vertical, less than 3% of revenue. A coordinated push toward US defense tech would require these firms to establish dedicated aerospace divisions with export administration regulations compliance and security clearance infrastructure. Capital intensive, yes, $50 to $100 million per firm. But aerospace contracts carry 12 to 15% margin premiums versus generic IT services. This is a margin expansion opportunity for India's largest export sector, and it's sitting right in front of them. The manufacturing angle is equally consequential. Modi's Make in India initiative has struggled to produce measurable wins, except in electronics and select automotive. But aerospace supply chain work is different. It's capital light compared to chip fabrication plants, requires minimal resource extraction, and generates 3 to 4 times higher per employee revenue than textiles or automotive manufacturing.